Very good afternoon to all of you. I welcome you to our subject that we are undergoing under operations, that is Management Control System or MCS. This has been coded as MMPF 003. In the previous sessions, we already have gone through the first two blocks, block 1, which was introduction part to MCS, block 2, which was how an organization can be separated into various responsibility centers. Today we shall be looking at block 3, how the management control process goes on. In that, we shall be focusing first in this particular unit 9, the budgeting and its reporting. In block 1, we saw what is the thing called as management control system, how a organization can set up the management control system across the various production lines, the various functional areas, etc. Then we saw how the management control system can be implemented. That means the various kind of authorities, as well as what are the various kind of challenges that the organization faces in management control system. In block 2, when we went to the responsibility centers, we saw how an organization can be decentralized, because in today's economic world, the business houses are growing at a very rapid pace. The business volume gets expanded, maybe due to addition of production lines, maybe due to the increase in volume of production, or we can also say it may be expansion of the business to various geographical areas like different countries or different states, etc. So there, when we looked at responsibility center, we saw the organization can be divided into responsibility center, like the first one was the cost center, second was the revenue center, third is profit center, and finally, or at the top, we have the investment center. Now the cost center is that segment of the organization we have seen that is responsible for the activities involving only the cost. It usually focuses on the production segment. Then we went to see the revenue sector. Now, when we look at revenues, it mainly focused on the sales value or the sales, how much sales is generated, etc. It does not look at or focuses on the cost of the items. Then third, we saw a organization can be broken down or decentralized into divisions according to production lines or according to various kind of geographical location, etc. There, the divisional manager is responsible for both cost as well as revenue activities. In other words, we can say they are responsible for the profits that is generated out of their division or the segment. Now, finally, the organization, when it is looking ahead, it should always plan for the future. When we say plan for the future, we try to say it is nothing but investing for the future. That means putting our capital in various kind of machineries, plants, land and buildings, research and development, etc., so that the future business volumes can be enhanced, or in other words, profits can be increased. So this type of responsibility center were called as investment centers. Now, in this particular unit, budgeting and reporting, let us see what is a budget, what are the different kind of budgets we have, how we can prepare the budgets by taking some examples, and the various reports that are prepared for the various levels of management. Now let us get an introduction to the term called as budgeting. Now the budgeting term comes from the word budget. So what I mean by budget, for any activity that is going to be undertaken in the future period of time, we have to plan it, and that plan can be estimated in terms of the rupee value or the monetary value. So that is called as budget for an activity. For example, simple example from our life we can take. Suppose we are going to hold a marriage in the house. Various kind of activities like painting of house, dresses, jewelries, the various what we can say activities like mehendis or the marriage, etc., are going to take place. So we try to list them out. What are the activities that are going to be carried out? Now we have to be prepared for the activities so that it can be carried out smoothly, because we know the activities will require monetary amount. So we try to express all the activities in terms of monetary value, and the total monetary value will give us the budget for the marriage ceremony. When we talk about budgeting, it is the process of preparing the budget. How a budget can be prepared, that will be taken under budgeting. So instruments used in planning as well as monitoring the operations of a firm. Now, budgeting is comprising of various instruments which will help for planning as well as monitoring. Monitoring means we can assess at any given point of time when the actual work is going on, whether the actual work is in accordance with the planned work or is it lagging behind. So budgeting will encompass various instruments. Now when we say what is the time frame for this budgeting process, we say the time frame can be short to medium term. What we mean by that? Now when we say short term, it can be daily basis, or it can be weekly basis, or it can be fortnightly basis, which in general is used by the lower level of management or the operational level of management. That means those who work in the operations, like the productions, like the purchase of raw materials, like use of laborers, etc. When we look at middle level managers or the executive managers, then we talk of the time frame in terms of either monthly basis or quarterly basis at most. When we say quarterly basis, it is 3 months at a time. When the plan is prepared for the executive level of management or the middle level of management, we try to take monthly basis or the quarterly basis. And finally, the top level of management or the corporate management will always look at the broader side of the activities that are going to take place in a time period of say 6 months or maximum up to 1 year. So they will be using the medium term plans. So short term to medium term we say according to the level of management. The Chartered Institute of Management Accountants, CIMA, it has defined the budget as a plan expressed in money, prepared and approved prior to the budget period. Now, always we prepare the plans for the future. The activities that are going to take place in this plan for the future period of time will have to be expressed in monetary terms. They are prepared and they have to be approved by the top management before the actual budget period starts. Now, when we say budget period, it is the time frame during which the budget already prepared and approved is going to take place. Now, here we say budgeting is translation of planned activities for a definite period of time. Always we have to attach for what time frame we are going to prepare the budget. Is it a daily budget? Is it a weekly budget? Or is it fortnightly, monthly or quarterly like this? So it should contain a definite period of time. So there can be two types. One is activities in physical terms, we call it as programming. That means how the activity is going to take place. When we try to see the physical aspect of it, we call that as programming. But when we look the involvement of money or the plans in monetary terms, that is in financial terms, we say that they are the budgets. Now, let us see what are the different type of budgets we can find. The first category or classification of budgets is functional budgets. Now we know an organization can be divided into various segments. The more the decentralization, the organization can be divided according to the production lines, according to the geographical location, etc., etc. But look at a simple organization. It will be having various departments. Sales department, we can start from production department, then we can have purchase department, production department, then we can have the quality department, personnel department, then the sales department, then administration, etc. These are called as the functional areas of an organization. So when we prepare a budget for any specific functional area, then we call it as a functional budget. Now what are the functional budgets we can have? Now sales. First we look at is sales. So here we look at what is the budgeted sales volume. what is the budgeted market share, what is the budgeted advertisement expenses we are going to spend in the budget period, etc. Another functional budget we can have is the production budget. Now we know the production process converts the various inputs into outputs through a conversion process. Now when we prepare budget for that, where it will be looking at how many units are to be processed in the given time period, we call them as the production budgets. The inputs can be the materials, can be labors, etc. Mainly, when we talk of input as materials, we talk of purchasing the materials. The raw materials are usually purchased from the supplier. Then we call that as purchase budget. Another budget we can prepare is the plant utilization. We have a certain term called as installed capacity. That means during any given period of time or for a given period of time, what is the volume of output that can be generated out of the particular production process. Suppose in particular month I can produce 2000 units. So suppose I say I will be producing at 70% plant capacity. That means I will be utilizing the plant at 70% level. So what will be my production level? Now immediately we can say 1400 units. So what is the plant utilization we are going to make? That budget will be called as the plant utilization budget. Similarly, office will be running to keep or maintain the records, etc., so that the things can work out smoothly. So that is called as administration budget. Similarly, what are the research activities we are going to carry out? For that, what are the necessary items? What are the necessary materials? What personnels are required? All these things, when expressed in monetary terms, which are used for research and development, we call it as the research and development budget. Then we look at the personnel budget or the human resources budget. We can say for any given period of time, what is the number of workers that will be used, be it in production line, be it in office, be it in sales, etc. How many are skilled, semi-skilled or unskilled? All those things will comprise to form the personnel budget. So when we prepare budget for a particular focus area of the organization, which is a functional area, then we called as they are functional budgets. So we can say it will be focusing on a particular portion of the organization. Now, these budgets can be consolidated. Consolidated means can be taken together. Now, when we have different functional areas for an organization, if we combine all the functional area budgets, we can have the consolidated budgets. That means a single budget which will be taking into account all the functional budgets of the organization for the given budget period. Two important consolidated budgets are cash budget and another is master budget. Now, when we are talking of cash budget, we generally focus on for each given time frame or time period during the budget period. Suppose budget period is 6 months and we prepare the budgets or the cash budget every month. So in each month, how much is the receipts of cash, how much are the payments of cash that are taken together, so that we can know whether we are having surplus cash or we are having deficit of cash for the forthcoming next 6 months. So accordingly we can plan out. If the requirement of cash is there, then we have to get it from some financial institutions or any other source. If we are having surplus cash, then we shall be looking at avenues where we can put it. So here the main focus is cash. And at the end of each period, what is the cash balance? Next is the master budget. When we talk of master budget, it not only focuses on cash, but all the aspects of the organization, all the budgets of the organization. So master budget, we can say, is a consolidation of all the functional budgets of the organization. Or in other words, we can say it is a single budget which tries to encompass within itself all the functional budgets. Another way of classifying budgets is according to the behavior. Now, when we are talking of behavior, we have fixed as well as flexible budgets. Now, what is a fixed budget? Now, the name itself is saying, once the budget is prepared for a given level of activity, it has to be carried out during the budget period without any changes. Because once a budget is prepared and approved by the authority for a budget period, then it cannot be changed. It has to be implemented. So when we have a fixed budget, we have to go accordingly. So if the future any kind of unforeseen scenarios occur, then the organization may be in a fix. Second kind of behavioral budget is flexible budget. So one may say here that in fixed budget, since it is fixed, here we shall be changing. No, we cannot change it. Instead, what we do, we prepare the budget for various levels of activity. So whichever level of activity we are undertaking in the budget period, that particular budget we shall pick up. That means for various levels of activities, already the budget is prepared. There is nothing to change, only we have to accept the budget for that given activity level. Another is periodicity budgets. Now, budgets usually are prepared maximum up to 1 year, that is annual, or shorter period, some may say per day, weekly, or fortnightly, monthly, quarterly, etc. As we know, there are three different levels of managements. One is operational management, that is the lower level of management, they will be looking at budgets which are of very short time period, usually daily basis or weekly basis or maximum fortnightly basis. The second level of management or the middle level of management is the executive level or executive managers. They will be focusing on budgets which may be monthly, quarterly, or at most semi-annual. That means 6 months. The top management or the corporate management or the top level of management, they will be focusing on annual budgets. Another way of classifying the budget is responsibility budgets. Already we have seen responsibility centers where there are four kinds: cost center, revenue center, profit center, and the investment center. Now, when we prepare budget for any particular segment of the organization, which can be identified as any one of the responsibility center, we call them as responsibility budget. It can be the cost budget or the revenue budget or the profit budget or our investment budget. So according to the division or the segment, these responsibility budgets are prepared. You can have further number of classifications, but these are some of the widely used classification of budgets. So we have focused on this. Now let us see how the budget setting process is carried out. The first step in setting up a budget is we have to look at what is the objective of the corporate. What is the requirement of the corporate in the forthcoming period or the budget period. So accordingly, looking at the objective, the corporate will be planning the profits. That means if it has various kind of divisions, so every division, how much profit they will be generating, that will be looked into. Then we take into account the nature of markets. Markets can either be buyer's market or the seller's market. Never will find a particular market to be singularly either buyer's market or the seller's market. So it will be changing dynamically in the marketplace. It will not remain constant at a given ratio. So the buyers and sellers, the force will be changing. So that will be taken into account in our budget setting. Another thing is principal budget factor. In other words, we also say it as limiting factor. Now, what is a limiting factor? Now, let us look at a particular budget called as purchase budget. When we look at purchase budget, we look at how much is the purchase of materials. Now, the material availability may be a bottleneck. When we say bottleneck, it may be seen as there are constraints to availability as per our requirements, because the materials may be in short supply, the materials may be in government's control, materials may be available according to the licenses, or materials will be imported which depends upon the foreign authorities. So any factor of production which uh, acts as a bottleneck or constrains the uh, production volume or in output in general, we call them as the key factor or the principal budget factor. So we have to focus on what is the principal budget factor in any of the budgets that we are going to prepare. Then we look at the sales forecasting, because the future is always uncertain, we know, but we can make an assessment of what is going to happen in the future period of time. It may be fruitful in most of the cases, but sometimes we also fail. Still, we go for the forecasting of sales because all other thing will follow the sales that is required. The inputs, the production, then the outputs that will be sent to the market are dependent on the forecasted sales. So another thing that is taken into budget setting is spending for the future. Now, while preparing budgets, we also have to focus on various kind of activities like advertising, like the donations, like charities, which has to be spent from the corporate's pocket. So this has to be looked into. This has to be incorporated in the budget. Now, budget setting process. What are the various recent developments? Many things are coming up. First, we can focus or look at PCB, which stands for Productivity Controlled Budget. So when we say productivity, we say it is the ratio of output to a given set of inputs. Higher the productivity, we say the better, or we are efficient and effective in converting those inputs into outputs as compared to others. Now, we have to look at what is the productivity of our organization. And when the budget is prepared accordingly, according to the productivity levels, we called it as PCB, Productivity Control Budget. Another development is ABC, Activity Based Costing. For example, let me take an example of use of electricity in the organization, where there are many departments. Now, according to the department's revenue generation, anyone can say that yes, we shall divide the electricity cost according to the amount of revenue generated. But this is illogical in real sense. One department may be having better productivity of electricity, but in the apportionment or bearing the cost of electricity, it will be suffering because its sales is high as compared to the amount of electricity used. So here, when we want to divide the activity cost, that is electricity cost, then we have to look at a suitable basis. Now electricity cost can be apportioned between departments according to the units consumed. That will be a fair division, and no one will be there to complain. Whatever is the use of electricity, you pay for that. So the cost we are bearing is based on the activity. So this is called as ABC, activity based costing. Another development is rolling budget. Now, when we are talking of rolling budget, suppose we prepare a budget for cash budget for 3 months. Suppose our cash budget is prepared for 3 months. Let us begin with January, February, March. So January has started. We have taken up the budget for January, February, March. When January is completed, we drop the month of January budget from the total 3 months budget. What are we left now? February and March. We add there the budget for April. So what happens? We have a 3-month budget, cash budget. How it was done? Now by discarding the last one and including a fresh one. So this will be continuing. When we end the month of February, we'll discard the month of February. We'll add May there. So the budget will be showing March, April, May. So the budget will be somewhat looking like rolling from time to time, discarding the last one and adopting the recent future one. Another development is ZBB, zero-based budgeting. It was developed in military circles, particularly US military. Traditionally, what we do when budgets are to be prepared, we only enhance it by a certain percent. Suppose 10% increase. So every item we go on increasing by 10%, and we say that the budget for the forthcoming period is already prepared. But this approach is not considered in military circles. What they say? Nothing of the last year will be taken into account. Whatever are the future activities you are going to undertake in the budget period, you prepare a budget for those activities only, and if you can justify that to the top management, your budget will be approved. That means your budget will never be based on the past budget. So the budget has no basis, zero base. So we call it as zero-based budgeting. We utilize the optimistic pessimistic approach. Optimism means when we prepare a budget, it is always for future period of time, we know. Future can have the optimism or optimistic things. That means whatever we have thought of are going to happen in that way. Or it may also happen that the future will become negative to whatever we have thought while preparing the budget. That means the optimistic is, yes, whatever we have thought is going to happen. Pessimistic is, whatever we have thought is not going to happen. So we have to take both the scenarios. Another is sensitivity analysis. What we do there when we prepare the budget, we try to find out the key factor. Suppose let us take key factor is raw material. We have prepared the budget. Suppose the raw material priced at rupees 10 per kilo. What happens when the budget period is going on? The raw material prices go upwards and it increases by 20%. So this definitely will be having an impact on the bottom line, that is the profit. Similarly, think of another scenario. If the raw material prices drop by 5%, what is the impact on the profit? So using computers, we can change the key factor in both the directions, that means upwards as well as downwards, and see the impact on the bottom line, that is the profit. This is called as the sensitivity analysis. We can also use probability tools while preparing the budgets. Since we say budgets are the future period, the probability aspect takes into account, or the tools take into account the future. Those tools will help us to prepare the budget in a better way. Now, when we look at one of the important things under budget setting process, that is sales forecast, what are the various methods available to us? One is quantitative statistical tools. That means we have the numbers, we play with numericals. The first one is time series analysis. Now in time series, we look at the past data and try to forecast what is the future sales value. So looking at the past number of years sales data, we try to prepare what is the sales for the next year. Another tool is regression analysis. When we say regression, it usually says it is the relationship between two variables, x and y. So y is always dependent variable, x is always the independent variable. Now this regression expresses the value of y. Y is equal to a plus bx. Now what we do there, we plot the previous year's the sales as well as the time. We know that time is independent, so we take it on x-axis, and sales is dependent on time, so we take it on y-axis. When we plot the points, we can fit a trend line which will be closest to all the points, and the equation of that line is y is equal to a plus bx. So whatever is the time period for which you want to forecast, we take it as x, and having the value of a and b that are constant from the equation, we can predict how much sales we can have. Another way is exponential analysis. Now it is just like a rolling budget. What happens? Exponential analysis says that while forecasting for the future period or for the next year, you take only the recent past data. That means the current year and the last year. Now, if you move on, discard the past data. The more the past, the more faster they are discarded because the future is dependent on the recent past. So, exponential smoothing analysis will tell you that forecasting can be done by using the recent past data. Then you can have probabilistic models where you can use the standard curves or the probabilistic uh, forecasting techniques like simulation, etc., to forecast the sales. Another is lead lag relationship. What do we understand by it? Now suppose suddenly you find the procurement of iron ore by the steel plants is increasing at a very fast rate. So it may lead to you may think that in the future the production of steel is going to go upwards. That means the infrastructure is going to be higher in the future years. So here the procurement of raw material or iron ores is the lead variable and the development of infrastructure is the lagging variable. You can establish a relationship between lead and lag variables. You can also have qualitative tools like experts' opinion, where we take advice from the various experts in the field to predict about the sales. We can also have brainstorming. We make the employees sit together or the management authorities to sit together and to discuss how much should be the sales. Another is through Delphi. That means you can ask various experts to answer the sales forecast by using certain questionnaire, and combining them all we try to predict what is the forecasted sales. Apart from that, we can also have field survey. That means when we actually go to the marketplace, take the view of the customers, we say that it is field survey. Customers may give you insight into whether the sales is going to grow in the future period or it is going to come down. Now here we have taken some examples which we will be doing. One I have taken is functional budget regarding purchase. Now you see consumption during 2023 was 50,000. Suppose our budget period is 1st January to 30th December of the year. So here when we say 2023, it is for the period 1st January 23 to 31st December 2023. How much material was consumed? 50,000. We want to predict how much is the material to be purchased for the current year or the budget period year, that is 2024. There we find a certain thing called as increase in capacity. What is it given? At 20%. Now when we are talking of increase in capacity 20%, 20% of 50,000 is 10,000. So the total becomes 60,000 rupees. We have to maintain material stock because we have to keep stocks which is for 4 months. Now material for a year is 60,000. So per month it is 60,000 divided by 12. So that is equal to into 4 months, that is equal to 20,000. So the total now becomes 60 plus 20 gives us 80,000 rupees. Suppose we have a opening stock for 2024, that means closing stock of 2023 was 20,000. So that makes it 60,000. Now, during the year, we expect an increase in the material price by 25%. So 25% of 60,000 is 15,000. And the total now purchases for the year 24 is 'So we have prepared how much purchases of material is going to be done in 2024 of materials by looking at change in capacity as well as the increase in material price. Now let us look at a cash budget. When we start 2024, suppose January, opening balance or balance of cash we have in our hand is 20,000. All are in 1,000 rupees. Now what are the receipts during the year? Now we have 80,000 from the sales. So the total of receipts and cash balance in our hand is 100,000. What are the payments we are going to make? Now these are the 3 payments. We have not paid income tax. So it is payment is 70,000. Closing balance is the receipts minus the payments, that is equal to 30,000 rupees at the month of January. Now when we come to month of February, January's closing balance becomes the opening balance of February. Sales 100,000 we get, so it makes it as 130. And payments during the year is 90,000. The cash balance now we have is 40,000. Again we go to period March. Last month's cash balance becomes the opening year 40,000. Dividends we have received from other companies from our investment is 10,000. So total now is 1,140,000, and income tax we have paid in March is 10,000. So the total is 130,000, and the cash balance is now 10,000 at the end of March. If it would have been a rolling cash budget, what we'll do for April? Now we'll discard January, we'll include April. Now let us look at a flexible budget. Look at the utilization of capacity. We have prepared capacity utilization at 60%, 80%, 100%. We can predict this for any number of capacity utilization. At 60%, number of units produced are 6,000. So at 80%, it becomes 8,000 units, and here at 100%, it becomes 10,000 units. Now let us see the cost. This one is 1,000 rupees, 60,000. This one is 80,000. This one is 1 lakh or 100,000. Now look at fixed cost. How much it will be? The name itself says us that the cost will not change. It will remain fixed irrespective of the volume of capacity utilization. You see here, the fixed cost is remaining same. So the total cost for at 60% level is 80,000. At 80% it is 1 lakh or 100,000, and at 100% total cost is 1 lakh 20,000. Now, these are some of the budgets, the tools of budgeting we have seen. Now, if we look at performance reporting, it can be according to level of management. That means whether they are corporate management or executive management or the operating management. Corporate management will be looking at the overall profits. Executive management will be looking at how much are the capacity utilization and how much are the profits for the various period. Operating managers will be looking at what is the daily capacity utilization, etc. We also can have special and routine reporting, and periods can be, as we have seen, very short and medium term reporting. Now when we look at degree of structuring, it depends upon the level of management. So in this way, the various kind of reporting takes place. So here we end our discussion. We'll meet again. Thank you. ରଖୁଛନ୍ତି।